let's talk about the picture first in the T-bill market. Of course, following yesterday's Omo auction, we hear there's a lot of volatility. I mean, what's your take?
Well, what has happened is the Omo yields have started declining, just as we've seen in the primary auction. We've seen a steady decline for over a period of several months, and we're seeing rates across tenors 91 up to 1 year below 11%. However, all this, sorry, not below 11, below 12%. But all this while, the Omo bills have held above 13. Yesterday, it was 13.03, and there was an oversubscription of about 100 billion. So we're expecting to see some more declines in the yields at the Omo auctions as well now.
Right, and I mean, we're expecting a T-bill auction coming up, Kubi, on the 20th, about 137 billion on offer. What are your expectations for that?
We're expecting a decline as well, because there's been a lot of interest. I mean, given the fact that we didn't have an Omo auction today and we have oversubscription from the last from yesterday, there's obviously some demand still in the market. What we're seeing on yields, even in the secondary market, we're seeing rates going down. We're seeing rates going maybe sub 11, just 1 or 2, below 11%. We're seeing the low 11, so we expect that there will be some decline again next week.
Right, and could be looking at the bond market. I mean, how is the market reacting to the release of that Q1 timetable? I mean, traders were anticipating a sell down today. Is that the case?
Well, it's more like, I think what people are looking at is the amount of net maturity we have. We have over 300 billion net maturities in February. That's significant. That's a significant amount of liquidity that's going to come into the system. And if it's not going to be mopped up, if it's not going to be in bonds across the tenors being offered, then it has to find somewhere to go. So it might go into, some of it will go into T-bills, and we expect, again, more downward pressure on the yields.
And before we go into your outlook of the bond market, I'd love to get your thoughts on that DMO calendar that was out for Q1. We hear there's some reintroduction of some new tenors. I mean, anything interesting when you look at that new calendar?
Well, yes, we're seeing 20-year. I think we have pretty much four different tenors right up to the 20-year. And yes, we'll see the kind of interest we have there. The market trades pretty well, but there could be some concerns about liquidity in the longer tenors and how active those bonds will be. But we'll see how the interest, we'll see how it plays out next month.
Right, and how do you feel, Kubi, that investors are responding in terms of the inflation numbers? I mean, we've been seeing the market flat, and of course traders say that's because investors are cautious about the inflation numbers coming out. What's your take on how the inflation numbers are going to play in the market?
Well, what we've tended to see is that the market responds more than anything else. The market tends to respond to liquidity, even more than inflation. What tends to happen is there's a lot of liquidity, and as we know, the market has been liquid for months. So it's more a case of what instruments can I get into? Can I do the treasury bills? And I think the last TB rate is actually below the last inflation numbers. So it's more a case of available instruments and the yield. Of course, the yield is a bit higher if you look at the effective yield, but it's more a case of what is available than strictly looking at the inflation numbers, because there isn't really much of an alternative.
Right. And very quickly, Kubi, I just want to quickly get your take on where you see inflation numbers going this year. I mean, we saw it sort of trending higher towards the end of the year. Do you think that we're going to see December numbers continuing to increase in terms of the inflation number?
Well, typically we see some levels of inflation around December anyway, because it's year-end, there's a lot of year-end activity, there's a lot of retail purchases. Again, there were a lot of factors last year with the flooding that contributed towards inflation. So there might be a slight uptick. Yes, it's possible.
Okay, Kubi, well, what is your outlook for the bond market going forward? I mean, are we going to continue to see a flat performance? And certainly, I'd love to get your take on where you see development in the bond market when we talk about corporate and state bond issues. We talked about this last year and how we might see more of those coming into play this year. What is your take?
Well, for corporates, yes, it would be a good year. Obviously, 2013, if you have the sovereign coming in at 11 to 12, between everything sub 13%, then you would think that you could issue a coupon, maybe 14, maybe even 13.5. So that tends to be a lot more attractive than locking in at 18 or 17.5, which would have been the case at this time last year. So for corporates, yes, there should be some interest in the bond market. For the state governments, there are political considerations. They might want to do bonds. I'm sure some states are in the process of issuing a bond, but there are also political considerations in terms of the states shouldn't be seen to be borrowing too much. Some of the states have already borrowed a lot. So those political considerations may slow down the pace at which a state would want to come to the market.